Yes, my dear student. How are you all? Super. I hope everyone is doing absolutely fine. Today I am here to discuss the case scenario multiple choice question of RTP for CA Final Financial Reporting paper for September 2025 exam. In the last video, I have already discussed all the descriptive questions of the same RTP. And what we have found that this time in the RTP, almost all the questions were new. So one thing is clear that now if you are doing selective study or you only focus on the question given in ICAI study material, that will not be sufficient. So you should be conceptually strong. I always say in the class that question may be any question, but you should be able to attempt that question in exam hall. Got this point? Any questions come, if you are conceptually strong, you will be able to attempt it. Don't think about whether you are doing correct or wrong. If you are able to attempt it, it means it will be correct only. Now today we are going to start a discussion of MCQ based question of RTP. Can we start a discussion? But before we start a discussion, if you are new to this channel, don't forget to subscribe the channel and do like the video and share this video with all your friends. Okay, sir. Let us start a discussion with the first case scenario 1. What is given? HIJ Limited is a globally diversified business conglomerate with operations spanning multiple business segments across various regions worldwide. For maintaining its financial record, the company follows Indian accounting standard. As the finance team diligently finalize the books of account and prepare the financial statement for the financial year ending 31st March 2002, it requires insight and accounting suggestion on the following transactions. First para is what? Not relevant. Point number 1. On 1st October 2001, HIJ Limited subscribed for 40 million of rupees 1 loan notes in J Limited. Correct? The loan notes were issued at 90 paise, means 90%, means at a discount of 10%, and were redeemable at 1.20, means redeemable at premium on 30th September 2006. It means it was issued on 1st October 2001. However, the year end is 31st March. This is the special point in this. Okay, sir. Interest payable on 30th September in arrear. The interest payable on 30th September. Okay, at 4% of par value. Okay, sir. This represents an effective annual rate of return for HIJ Limited for 9.9%. So they have given effective rate of interest. HIJ Limited intention is to hold the loan note until redemption. So of course it will measure at amortized cost. So can you see initially it will measure at what? 40 million into 90% means discount 10%. So it will be how much? 36 million. And can you see will add interest at 9.9%. So interest will be added because it was issued on 1st October 2001. So 31st March it is 6 months. So you need to add 6-month interest. So 6-month interest will be what? Into 9.9% into 6 divided by 12. How much it is? 1.782. And minus, there is no contractual cash outflow for the first year because contractual cash outflow will be based on contractual rate of interest, that is 4%, but that is on 30th September, means after 31st March. So this only become your amortized cost. So it will be how much? Plus 36. So that is 37.782. Okay, this is the first part. I don't know what is the MCQ. I have just explained you the para. Then what is given on 1st April 2001, HIJ Limited commenced joint construction of property with J Limited. Similar question we have in our India's 111. Same to same question we have. For this purpose, an arrangement has been entered into that provide for joint operation. It is a question of joint operation and ownership of property. All the ongoing expenditure comprising maintenance plus borrowing cost is to be shared equally. It is 50%, 50%. The construction cost was completed on 30th September 2001. It was ready for use on 30th September 2001. So as per India's 111, what they said ki all the assets and liability will be proportionately recorded, proportionately incorporated in the joint operator books. Correct now. The 50% recorded in both joint operator books. Yes sir, yes sir. And can you say so the PP and the PP will be recorded as per India 16. So it is it is ready for use on 30th September. So once it is ready for use, will not do further any capitalization. And utilization of the property started on 1st Jan 2002. This is not relevant. At which time the estimated useful life of the same was estimated to be 20 years. I say there is one clerical mistake in this. The useful life will be always started from the date when the asset is ready for use, not from a date when the asset is put to use. So even the question has said like this, we'll always assume this 20-year is from 30th September, not from 1st Jan 2002. Got this point? Yes, sir. Total cost of construction of property is 40 crore. Beside interest accrued, the cost was partly funded by way of loan of 10 crore taken on 1st Jan 2001. Taken on 1st Jan 2001, but the construction started from 1st April, means the borrowing cost will be capitalized from 1st April to 30th September. 1st April to 30th September means 6-month capitalization will be done. Yes, sir. The loan carries interest at an annual rate of 10% with the interest payable at the end of the year on 31st December each year. The company has spent 4 lakh on the maintenance of such property. The company has recorded the entire amount paid as investment in joint venture in the books of account. Such a suitable accounting treatment. This is the copy paste of the question taken from ICAI study material. However, it is an MCQ based question. Therefore, this para was not relevant actually. Okay, sir. Yes, sir. So we can see that it was 40 crore and will capitalize borrowing cost for 6 months. So it will be how much? What is the loan amount? 10 crore into 10% divided by 2 means 6 by 12. So it is 0.5. 0.5. It will be 40 crore. 40.5 crore. 40.5 crore. And depreciation will be from which date? From depreciation will be from 30th September. 30th September means 6-month depreciation. 6-month depreciation. And what is the useful life? 20 years. We will do 1 by 20 into 6 by 12. So 40.5 divided by 20 into 6 divided by 12. It is how much? 1.0125. So it become minus 40.5. That is equal to how much? 39.4875. However, 50% will be share of each joint operator. Got this point? Yes, sir. Now let us now answer all the MCQs. What would be the initial measurement of financial instrument as subscription of loan note in Jade Limited? Initial value will be the discounted amount only, that is 36 million. So option number D is correct. What would be the closing balance of financial instrument as subscription loan notes in Jade Limited as on 31st March 2002? Already we calculated. How much we calculated? 37.782. So 37.782 means option number C is correct. Yes, sir. With respect to point number 2, what is the nature of agreement? Agreement is the nature of joint venture. No, agreement is the nature of joint operation. It is given in the question only. So option number B is correct. Okay, sir. What will be the initial cost of PP appearing in the books of HIJ Limited? Means it is HIJ is one of the joint operator. It will be 20 crore 25 lakh, means 40.5 into 50%. So 20 crore 25 lakh. So they have said cost. The cost will be this only. Calculate depreciation charge for the year and date 31st March 2002 to be charged by G Limited, means another joint operator. So that already we calculated. We need to only find out the 50%. It is 1.00125 divided by 2 kar do. So that is 0.50625. So answer will be what? It will be, it is option number A. Option number A is correct. Got this point? Let us check the answer whether it is correct or not. Okay, so check it. It is 36. First one is correct. Second one is correct. Third one is correct. Fourth one is correct. And fifth one is correct. Simple. Okay, let us come to the next case scenario. Now, case scenario 2. FA Limited is a company which manufacture aircraft part and engine and sell them to a large multinational company. Same question have been already asked in one of the exam, like Boeing and Airbus industry. Following other details of some of the transaction entered into by the company. On 1st April 2002, the company began the construction of new production line in its aircraft parts manufacturing said. The cost related to production line are as follows. So we need to find out what is the amount to be capitalized to the cost price of property, plant and equipment. Cost of basic material, lease price 12.5 less 20% trade discount. It will be capitalized. Recoverable goods and service tax incurred but not included in purchase cost. It will not be capitalized because it is recoverable. employment cost of the construction staff for 3 months till 30th June. So it is 3 months given. So we need to find out what is the capitalization period, and based on that we need to capitalize it. So of course it will be capitalized, but for how many months we don't know. Other overhead directly related to construction, this will be also capitalized. Payment to external advisor relating to construction, of course this will be also capitalized. And expected dismantling and restoration cost, this will be capitalized, but at present value you need to find out the discounting factor. The production line took 2 months to make ready for use and was brought to use on 31st May 2002. So it was brought to use, so ready for use and brought to use are the same date only, 31st May. Okay sir, so it is 2 months, so it will be 1.20 into 2 by 3 and the balance will be charged to profit and loss account. So we will do into 2 by 3 and that will be 0.80. Okay sir, yes sir. The other overhead were incurred during the 2-month period ended on 31st May 2002. They included an amount of abnormal cost of 0.3 lakh caused by major electrical fault. So other overhead include 0.3 and that is what? Abnormal loss, that will not be capitalized. So we will do minus 0.3, that will be equal to 0.60. The 0.60 will be capitalized. Okay sir. The production line is expected to have a useful economic life of 8 years. After 8 years, FA Limited is legally required to dismantle the plant in a specified manner. So dismantling cost is given and you can see the amount of 2 lakh has been given, which is already given initially also. Okay sir. Included in the cost of estimate is the amount that is expected to incur at the end of useful life of the production line. The appropriate discount rate is 5% and the present value they have given 0.68. Okay sir. We will do 2 into 0.68. So 2 into 0.68, it is 1.36. So we'll add here 1.36. 1.36 will be capitalized. Okay sir, yes sir. 4 years after being brought into use, the production line will require a major overhaul to ensure that it generates economic benefit for the second half of the useful life. This is the main para. The estimated cost of overhaul at current price is 3 lakh. Means the same overall is incurred as on today. As on today means on the date when the asset is ready for use. As on today, then what will be the amount of that expenditure? That will be 3 lakh. It means, can I say, if we apply component accounting of depreciation, whatever cost we calculate, that will be including of this major overall cost, and that major overall cost will give benefit for the first 4 years. Therefore, it will be depreciated for the first 4 years only. Correct? Got this point? Yes, sir. No impairment of the plant has incurred by 31st March 2003. It means, can I say, first we can find out what is the cost price. It is 10 plus 1 plus 0.8 plus 0.6 plus 0.5 plus 1.36. So that become, once again, 10 plus 1 plus 0.8 plus 0.6 plus 0.5 and plus 1.36. That is 14 point. Where I'm doing wrong. Oh, I'm adding 1 minus 1. That is 13.26. So answer is what? 13.26. 13.26. This will not be added. This will not be added. Okay. That is 13.26. So this is the cost price. Can you say out of that the 3 lakh will be the current price of major overall? Yes sir. And 10.26 will be the other cost. So the useful life of this will be 8 years and the useful life of this will be 4 years. Got this point? Now what is the requirement of the question? That will read and based on that we'll answer it. Yes sir. During the year ended 31st March 2003, FA Limited provided consultancy services to the customer regarding the installation of new production system related to aircraft part. The system has caused the customer considerable problem, so the customer has taken legal action against the company for the loss of profit that has arisen as a result of the problem with the system. So some customer has filed case against the company. The customer has claimed damages to the tune of 1.6 lakh. So they have demanded a payment of this much amount. The legal department of FA Limited considered that there is a 25% chance the claim can be successfully defended, means 75% chance that it cannot be defended. Therefore, there is a present obligation arising from past event. Outflow of resources probable and reliable estimation can be made. Therefore, as per India's 37, we should create an amount of provision. An amount of provision will be 1.6 lakh. Yes, sir. The legal department further stated that they are reasonably confident the company is covered by insurance against this type of loss. The accountant feel that nothing need to be provided for the claim as the company is suitably covered against the possible loss. This is totally bakwas. Insurance claim, it is nothing but reimbursement from third party. If there is some reimbursement third party, that is a separate transaction, but we need to provide the contingency if any. So of course we should create a provision of what? 1.6 lakh. Yes sir. Then point number 3, they have given FA Limited as an associate company, Flynet Limited. Following are the information of Flynet Limited for the year ended 31st March 2003. They have given some information to find out the cash flow from operating activity. So what will be plus, what will be minus, that you need to find out. So net income after tax they have given, decrease in account receivable. This will be added. I am not saying y plus, y minus, because of course cash flow statement you are all expert. Yes sir. Depreciation will be added. Increase in inventory will be minus, increase in account payable liability it will plus, decrease in wages payable it will minus, tax charge for the year, deferred tax liability because it is net income after tax, so we'll add back means 15 will be added back, profit from sale of land it will be deducted minus. So what is the answer? 120 plus 20 plus 25 minus 10 plus 7 minus 5 plus 15 minus 2. The answer is 170. Answer is 170. Now let us answer all the points. Which of the following items need to be capitalized in determining the cost of production line? So of course this will not be capitalized. Recoverable amount will not be capitalized. Initial amount of estimate cost of dismantling will be capitalized, but not at future value, at present value. So option number D is correct. Okay sir. Calculate a company associate Flynet cash flow from operation. Already we calculated 170. So option number B is correct. Chalega? Yes sir. Then what accounting treatment should be done in FA Limited books for the year ended 31st March 2003 as the customer has taken legal action? The provision of 1.6 lakhs to be recognized with the corresponding charge to PL. So option number B is only correct. Yes sir. I think you can read the balance option, that is not at all correct. Compute the total amount to be charged to SOPL with respect to production line. Just try to understand, whenever they say total amount to be charged to SOPL in respect of production line, it means in respect of PP. So in respect of PP there are two amount. One is finance cost for dismantling provision and one is what? One is that depreciation. Got this point? So with respect to production line, you can see with respect to production line is PP. So for PP there are two expense. One is depreciation and one is finance cost. So can you say 1.36, the discount rate is 5% and the date when the asset is ready for use is 31st May. Means can you say we need to add interest for how many months? 10 months. We need to add interest for how many months? 10 months. So it will be 5% into 10 by 12. How much? 1.36 into 5% into 10 divided by 12. It will come 0.057. Now we need to calculate depreciation. So already I have said that depreciation there are two components. One is 3 lakh multiplied by what is the useful life? 4 year, 1 by 4, and depreciation will be 10 by 12. So how much? It is 3 lakhs. So 3 divided by 4 into 10 divided by 12. It is 0.625. 0.625. And then the balance component is how much? How much we calculated? It is 10.26. So 10.26. So 10.26 into 1 by 8 is the useful life and 10 by 12 for 10 months. So 10.26 into divide by 8 into 10 divided by 12. It is coming how much? 1.06875. 1.06875. So 0.625. Depreciation become approximately, it become this was 0.057. Okay. Now depreciation approximately become 1.069, you can say. So it is 0.057 plus 1.069. It is coming how much? Sorry, my mistake. Depreciation total is what? 1.069 6875 plus 0.625, it is coming 1.69. So approximately we can say 1.69. If you just sum total it is 0.057. So it is 1.75. So which answer? I think approximately it is option number C. Option number C. What is the one more point they have given? What is the balance of provision for decommissioning cost? So it is 1.36 plus 0.057. Am I right or not? So 1.36 plus 0.057. That is what? 1.417. Means 1.42. So both answer we got. Both answer we got. This is correct and this is correct. But normally students are confused about abnormal loss and there was one GST though will not be charged to profit and loss account, but abnormal loss will be charged to profit and loss account. Correct. And there is one employee cost for the third month that will be also charged to PL. So they will add that also. That don't add that amount because that is not related to production line. That is some other expense which will be charged to profit and loss account, but that is not related to the production line or the cost price of PP. Have you understood this point? Yes, sir. Compute the cost of production line to be capitalized initially on 31st May 2000. That already we calculated 13.26. Option number A is correct. Super easy. All points done. So with this MCQ completed, let's see, verify the answer. Option number D, point number 6. Option number B, 170, then 1.6 lakh, then 1.76 and 1.42 and 13.26. All answer done. However, this was very simple. I have just done it to complete the MCQs. Okay, because if I will not do it, you will say, sir, you have not done the part 2 of the RTP MCQs. Correct now. But now it is done. But once again, I just want to say that this time in RTP, they have given almost all the new question and quality question. I'm not saying difficult, it is very simple. But those students who actually prepare only from question bank point of view, correct now, they will only just go to exam hall based on the question from ICAI study material. There is some problem. I don't know whether what type of question they are going to ask in your exam. But if they ask this type of question in exam, for that conceptual studies required. So any student who is just listening this class for the next means for the attempt after September 2025 exam, I just want to inform that if they have given RTP this time for September 2025, it means they are now targeting Jan 2026 and onward attempt. I don't know about this attempt. This attempt the question may be from ICAI study matter similar, but this RTP is just one indication that for Jan 2026 and onward attempt, believe me, the question is going to come from out of the book, I will say, or they may ask this type of question in a different way. Means any question of ICAI study they will try to modify it. Be careful. All the best for your exam. Love you all. Bye bye.